Hi, everybody. I'm Al Ganoza. Today I'm meeting with Paul Fair of Paul Fair Associates, a retirement and income solutions firm. And Paul, tell me about you, your investment philosophy, and a philosophy for investors and retirees.
Well, thanks, Al. I have over 23 years experience working with retirees and the soon to retire, and individuals that provide solutions to help them in their retirement and their challenges that they have in retirement.
Now, what do you mean by challenges and solutions?
Well, people as they get closer to retirement change ideas about their money. Okay, they want it to last. So there's always a challenge to that. You have inflation. We want when you have money in the market, you want to prevent losses because you want the money to be there and to last as long as you're going to last. So that's a challenge, and solutions are help to smooth that out and to put people in programs that then give them a better opportunity for the money to last as long as they last.
I guess the challenge always is, how do you get competitive returns while reducing your losses?
Well, years ago you could go put money in the bank and make 5-6% all guaranteed, and it worked out. Today the bank rates are so low, people are willing to take a little bit more risk and to try to make better money mostly in the market. Some of the problems that they run into is the volatility of the market. If we look at the market over the past 15 years, it's been all over the place. And it really doesn't look like that's going to change anytime in the near future about the ups and downs of the market.
Okay, and I guess the question is, can you give us an example of a managed portfolio?
Let's talk about the professionally managed fixed income total return portfolio. This is a portfolio that is I use from a company called Clark Capital. If you take a look at this slide, you'll see that there's a circle on it, and there's three different areas. The first area is a dark blue, a yellow, and a gray, or a light blue, I should say. This is a tactical portfolio where they're actually going to allocate money to different parts of fixed income and rotate it to wherever the money's being made. When we look at that, the first area that will come up, in the blue box you have short-term treasuries. This is used when there's volatility in the market and you're trying to protect your assets. The second box is the yellow box, and this is a box that's made primarily of longer-term treasuries and high-quality bonds. Sometimes there's use for this. And the last box is the blue box. And in the blue box, you have mostly high-yield bonds. These are bonds that pay a high dividend, lower quality, and will rotate between the different sectors depending on what's going on at the marketplace and what the market dictates where they go. Let's take a look at a snapshot of the portfolio on March 31st at the end of the quarter 2013. If you take a look at this, we'll look at the holdings of the portfolio first. And at this point in time, the holdings were 93% in high-yield bonds. The second part was a little bit, 5% in preferred stocks, which are like a hybrid between stocks and bonds, and in cash, 3%. The second part you see is the characteristics of the portfolios. And you can see it has quite a few holdings in it, and it gives you the average yield or the dividends that are being paid. And this is paying somewhere in the 6% area as far as dividends go. So they will change this as time goes on. Sometimes the dividends are a little higher. Whenever you're in the short term, protecting the principal, it's going to be a bit less. The next area that we look at, if you look at this large blue box here, or the large box, this was the holdings that this portfolio had from the time it started, January 1st, 2005, until present day. And this is all color-coded to the same circle that we looked at in rotating the bonds. The dark blue represents when you're in high-yield bonds. Mm-hmm. The light blue is when they're in the short-term treasuries. And the yellow is when they're in the longer-term government bonds, treasuries, or in corporate bonds, or high-quality corporate bonds. If we look at this, you'll see a red arrow. This red arrow, this is really, to me, one of the most important parts of this whole program. Because if you look at that, you look at the dates of that, you're looking at 2008, mid-2008 to the end of 2009. If you remember the market back at that time, and I'm not talking about the stock market, I'm talking about all the markets, the stock market, the bond markets, everything was getting clobbered. Nobody knew what was going on, and this portfolio went to cash. Now, during that period of time, the S&P 500 dropped about 40%. At the same time, the high-yield bond index had dropped somewhere around 30%. This portfolio went to cash and didn't lose money. As a matter of fact, for 2008, this portfolio made somewhere in the neighborhood of 2% for the year.
And when you say go to cash, you mean to just take it out in the sidelines, but it doesn't lose any value there?
Right. They switched it from high-yield bonds, which was in just before that, the quarter before, and they put it into the short-term treasuries. Now, the short-term treasuries didn't pay much. They're like a money market. They're paying 0.1%, but which would you rather have? Something that's paying 0.1% or something that lost 20 or 30 or 40%?
They're the so-called safe haven, right?
Exactly right. Moved it over and took care of business. The next chart we look at here, if you look at the chart, you'll see a red line, and that's the Barclay High Yield Index. So every portfolio that I know of, what you want to look at is a benchmark. If it were in stocks, you'd use the S&P 500 as a benchmark, or at least a number of people would. In this case, we're using the Barclay High Yield Index as a benchmark to see how the portfolio does compared against a benchmark. So if you look at this, and the first, when you look at the red circle, you can see that during that period of time, the index took a pretty good dip. If you look at the next slide, the blue circle shows what this portfolio did. And you can see it really didn't go down much at all. As a matter of fact, maybe took a little dip back in 2009 when they got back into the bond market. Now, if we look down here in the green box, what you're looking at here is the standard deviation and return. This has had very good competitive returns, but the deviation is low compared to the index. The index had a deviation of 11. The higher the number, the higher the swings of the gains and the losses. What I have found is most people that invest in the market, especially when they're retired, they get very concerned about their money. So consistency is an important factor. One of the things that I've found is if a person gets a 15% gain, they get pleasure. They get a 7% loss, they get pain. The 7% loss pain outweighs the 15% pleasure, especially when you're retired, because you're not putting money into your retirement system any longer. And while you're doing this, it sometimes negates what's going on in the market. So if you had a 401k and you're putting money into it and you lost 30% at the end of the year and the market was down 40, you think you did okay, but that's because you put 10% into it. That's the problem. The next slide is a bar chart. Now, this is the same chart that you just looked at, only in a different format. The other one is more graphic. This is more just bars. If you look there in the red circle, you'll see that the benchmark, which is, in this case, the high-yield bond, Barclay High-Yield Bond Index, dropped 26%. The blue bar right next to it is this portfolio, net of fees, and that made 1.08%. And by the way, one thing I just want to point out on this, actually the gains on these charts are all lower than what they actually are because due to compliance reasons, all the net fees are set up at a certain level, 3%, when the actual management fees are considerably less than that. If you look at the next chart, here with the green circles, we'll see that in 2009, the portfolios came back, the benchmarks came back. The benchmark was up 59%. That's pretty good roaring back, minus 26 plus 20 plus 59. And this portfolio made 38% that year.
Wow, so that's a good return.
Well, yeah. You know what? During that time, though, the S&P 500 for 2008 lost about 37%, and in 2009 it only made about 26%. It didn't roar back like this did. This chart picks out 3 years, 2007, 2008. And it's got a minus 26 and a plus 50 something and a plus 15 for the index. And the portfolio did a plus 1, a plus 20, a plus 37, and a plus 11. If you would have invested $100,000 in the portfolio at the beginning of 2007, at the end of 2009, that $100,000 would have been worth $155,000, whereas the index would have been worth $134,000. But which would you rather have? You started off with a 26% loss and then got a 59% gain? Or would you rather have something that was more consistent and you made more money to boot? That's especially important if you're drawing money out of an account. Because if the account goes down and you draw money out, let's say you're drawing $500 a month out of an account, and the market goes down, you're actually drawing out more money in that because the account went down, and you're compounding the problem.
And that's how a lot of people live as they get older, right? Drawing out of an account.
Absolutely, sure. Well, that's what the money's for, especially IRAs and 401ks and so forth. Now, this next chart just talks about drawdown. Let's talk about what a drawdown is. Let's define that. A drawdown is anytime the market is at a point that it starts down. The drawdown is how far it went down and how long it took to get back to the point that it started going down from. So if you look at this chart, it starts at 0. There is no gains in it. It's only saying, no, the market's doing fine. So if we look at the first box, we can see that the drawdown on the index, which is in red, dropped 33%, and it took about a year and a half for it to get back to even. So that's pretty good. That's significant, especially if you had $200,000 in the market and your account dropped $66,000, I would have to think that would get your attention.
Yeah.
Now, this is a drawdown on this portfolio. Now you can see the box is a little bit smaller. The largest drawdown it had was a little bit around 5%, and the drawdown lasted about 3 quarters or 3/4 of a year. And you can see it was a much less drawdown. The following chart just puts them together side by side, compare for yourself. If we look at this, which would you rather have? Something that was unmanaged or something that was and you had better returns, less volatility? I would think you'd probably go with the less volatility and better returns. This company that manages this money, Clark Capital, I use them basically for fixed income portfolios. They have a 4-star rating. Morningstar, a lot of people don't realize, but Morningstar rates stocks, bonds, and mutual funds. But they also rate money managers. So in Clark Capital's position, their fixed income portfolios, all of them put together, average out to about 4 stars. If you look at the next slide, this one here just talks about or shows you the portfolio we just went over. Morningstar rates it as 5 stars. And by the way, this is as of December 31st, 2011, this slide relates to. This was the portfolio from 2011 going backwards to 2007. And it averaged 13% a year, 13% a year for 5 years, when the index did 6.5%. This was rated the number one peer group of all the fixed income managers in the entire country. They beat 99% of all the other money managers and taxable fixed income portfolios in the whole country. One thing I didn't mention was, besides this portfolio with them, with the high yield income, also they do a very good job with the muni bond portfolios, not mutual funds, but individual muni bond portfolios, and also in just regular corporate and corporate bonds also. So for fixed income, I think it's a great place to have your money.
It would seem to me, and maybe you know, are people skittish after what happened? I mean, it's been, what, 4 or 5 years, and are people still a little leery about their money?
Well, like a cat in a room with 9 rocking chairs. They're skittish. I asked the question to people, do you think we're out of the woods yet? You think the market's going to just keep going up from here. And the basic answer I get from them, I don't know of anybody, and that's not me, it's them saying, I don't know of anybody that thinks that.
Yeah.
Because they start and they say, well, you know, there's $17 trillion in debt now, and whatever the number is, and unemployment and everything else. People, they're still concerned out there. And you go over the past, since 2000, just look at up and down, up and down, up and down. Now, we happen to be up now, and things are doing very well, but how long will that last? That's why the actual allocation, the proper allocation at the proper time is so important. You can buy something and hold it and hope it works. I'm not saying we're going back to the Great Depression, but in 1929, during the Depression, the market went down. It didn't get back to even. The drawdown was until about 1954, 1955, and that's assuming that you never took a penny out of there, and it's assuming there was no such thing as inflation. So would you think $1 in 1950 bought more or less than it did in 29? Well, in 29 it certainly had more buying power. So we can go through significant issues, and when you're retired, you want to protect your money. Remember about the gain and the pain. The pain shows up a lot more than the gain does. Where do we go from here? If you're looking at this on my this video on my website, there's a place where you can download the whole piece on this that you just went through. I picked out some of the charts and some of those things, but there's a whole report on that's up to date. So if you're looking at this, it'll give you right up to date information. If you'd like to talk about this portfolio, get further information, here's my information, my website, my name, my address, Paul Fair. I'm in Sinking Springs near Reading, Pennsylvania, and I work with retirees, and I help them with solutions for their retirement.